Nvidia's meteoric rise is indicative of another structural trend. Investors are betting that the biggest companies will get even bigger. So far this year, the 10 largest market cap companies in the S&P 500 have gained roughly 45%. Without them, the entire S&P 500 index would be in the red. Instead, it's up 10%. Now, this applies not just to tech, but to banking, healthcare, energy, and a whole host of others. In fact, in every US industry except for telecommunications, the top 10 stocks have outpaced the rest. Now, the thesis that many believe is that this is a flight to safety. Investors are scrambling to buy shares in companies with large balance sheets and strong margins that can withstand economic volatility and technological change. In other words, they're de-risking. Now, Scott, when we discussed this, particularly in relation to Nvidia, you mentioned that you're taking up a new strategy called pairs trading. Could you explain to us what that means and what your thesis actually is?
Well, so first off, I just want to say, I want to lay down the context that unless you have the capital to wildly diversify and you sort of do this for a living, and I would argue I sort of do this for a living, the best investment strategy is low cost, ETFs, diversified, Vanguard, and just invest regularly, force yourself, any sort of tax advantaged, IRA, Roth, any sort of employee match, max all of that out, put it in low cost funds, diversified funds, and then just ignore it. And when you're 65, you'll be able to retire. I can't help it. I invest in stocks. I do invest a lot in funds. I'm hugely diversified. But an interesting strategy, if you want to take out market risk, is pairs trading. And what that is the following. I can't get a grip on this market. It feels, on the one hand, it just feels historically expensive to me in terms of a price-earnings multiple, given some of the clouds on the horizon and the insecurity in the world. At the same time, I can see something like generative AI unleashing this incredible tech age with all sorts of productivity, and I could see the market just catching fire. You could tell me the market was off 20% in the next year or up 20%, and I would say, well, of course it is, and give you reasons why for each. So a market neutral strategy is to pick 2 or 3 stocks to go long on and then pick 2 or 3 to go short on. And the reason why you do that is I don't want to take a market bet. I want to bet on companies. Technically, this is what hedge funds are supposed to do. The typical hedge fund is 60% long, 40% short, and then they ramp it up with leverage, but we won't talk about that here because they have a bias towards the long position because the natural trajectory of the markets over time is up. The markets do go up over the medium and long term, but they take out a lot of market risk. That way, if the market gets absolutely hammered, they're still okay because they're short on 40% of their stocks. And keep in mind, market dynamics will always trump individual performance. So you can be amazing, but if we go into a depression, you're getting laid off. You can pick a great company that performs, but if the market gets cut by 30%, you're going to wake up and find that that amazing company's stock is down. So this is a means of taking out some of that risk if you're confident that you have some insight into which companies you think are undervalued or overvalued. And I'm thinking about doing it because I want some exposure to the equity markets. I do think there are some companies that have gotten carried away in the hype cycle of AI. I do think there are some other companies that have been caught on the wrong side of the AI hype cycle, see above Google, and this is a means of exiting from market risk, but still being exposed to some trends and some dynamics in the equity markets.
And then finally, just returning to the original stats we were talking about, the S&P would be down if it weren't for the top 10 biggest companies. I think last year we had this feeling that big tech was kind of fading out. I think you used the term, or someone used the term, biggest tech, referring only to Apple because Apple felt like the big winner. But now you look at the performance of all of these companies. I mean, year to date, Microsoft's up 37%, Google 39%, Amazon 42%, Meta's up 118%. Have we officially returned to the big tech era? And if we have, how should investors respond to that?
Well, I think what's happened is every time there's a massive innovation or kind of the next thing, the next big thing, if you will, that usually the value creation accretes to traditional players or to new players. So e-commerce benefited the new guy, Amazon. The phone went to existing players. I think you'd argue that metaverse didn't really go to anyone. crypto. The crypto surge went to new players. It looks as if generative AI, if you think it's the next big thing, and it looks as if it is going to go to existing players. I mean, OpenAI has a $30 billion market cap, or valuation, I should say, in the private markets. But I would imagine that Microsoft has increased probably a couple $100 billion since they made that initial investment.
Yep.
And everyone's kind of waiting on it. Amazon, it's the big guys. It's the ones with processing power that can actually service new AI companies and also can put on the front end applications that will be really dominant. For example, Microsoft just released or incorporated sort of a text-based or an AI, generative AI for writers that is essentially a Notion AI killer.
Yeah.
And bundling and capital are really, really powerful. So we have kind of the existing players swelling in value, and now I think 25% of the S&P is just 4 or 5 companies. And the thing about a pair trade, just going back to that,
yep,
is it plays on a couple other things. One, the reversion to the mean. Everyone says that compound interest is one of the most powerful forces in the universe. I've always thought reversion to the mean is really powerful, and that is when a stock becomes just crazily overvalued in terms of PE, eventually it kind of finds its footing again. And the same when it's too low. I mean, just sitting here 8 months ago, not even 8 months ago, 7 months ago, Ed, Meta was trading at a PE of like 9. I mean, it was trading as if it was Ford Motor and had no growth prospects. And it was sitting on top of a massive cash volcano. And what do you know? It's back to where most big tech plays. So reversion to the mean and collapsing that with a market neutral strategy, again, are sort of the attraction here. But we're seeing a crowding again to the big guys. And Tim Wu, professor at the Law School of Columbia, says that the biggest threat from AI is that we're again concentrating more power in the hands of fewer and fewer people.